All right, everybody, this is Jeff Scott, and this is tape number 2. I wasn't happy with the first one, and some of the comments about how difficult it was to read just reiterated, so I'm doing this over. Hopefully the audio will be a little bit better. It's 6 a.m. on Monday morning. The title for this weekend is Weekend Review Bull Trap. There's a bear on the horizon. There's my email address. I think everybody is aware that last week was a challenge on Thursday and Friday, and the smoke signals of the bear market are showing up over the horizon. And is there really a bear there, or is this just going to be another trap and the market continues up? We can only talk about what we see, make a couple of educated guesses, but there are some mixed signals, but I can tell you that I, for one, am a bit concerned that maybe it is different this time. Disclaimer, as usual, this is for education purposes only. Any recommendation I make is in the spirit of education, not investment advice. I'm a doctor, not a broker, and I have purchased all the tools that I use during these programs, and these are what I use in my daily analysis. One of the things that I learned early on from Ian is that you need to become your own guru. You can listen to others, you can even rely some on what you learn from other folks, but at some point you're responsible for making your own decisions. My balance is my balance, your balance is your balance. You have to make your own decisions that are best for your balance. The size of my account may be different than the size of your account, and we all have different needs and expectations. I've learned from great people like Ian Woodward and Ron Brown, Alexander Elder, O'Neill, Rouse and Hatcher, Bigelow for Candles, Minervini, and Stein, how they apply some of the ideas that I use. And a polling volume analysis Vanthar for position sizing. Here's some of the webinars, some of the websites, rather, that I find useful. Didn't need to hit that. I have a lot of different programs which I purposely hide. I need something for trading, which I use both TradeStation and Thinkorswim. They both have advantages. Thinkorswim being free totally is a nice thing, but because of the open architecture and lack of ability to protect code, you have many less people writing code on a regular basis for Thinkorswim. TradeStation has a huge community writing apps, but you also have a much better radar screen versus MarketWatch. TOS has had some performance issues. They came out with an update this weekend, and I'm looking forward to testing that out during market hours when my scans will no longer run because of server challenges on their end. I use HGSI for my aftermarket analysis, frankly, during the market as well, but not real time. EdgeRater, Magenta Trader, and then MarketSmith. Stock patterns are cyclical. You need to know where you are. This pattern of ambivalence, greed, uncertainty, and fear gets repeated in every time frame and every instrument every day. And you just have to look at the right time frame to see it. As I look at this, I've commented how we keep going into where this red circle is. And every time I think we're going to fall down into fear and selling, the market does a quick reversal and goes up again. It'll be interesting to see if we do that here, or if we really are going into stage 4, which is what my guess is, but that's only a guess. Bold slide, but an important slide in that in a strong uptrend, it's pretty easy to see that you can go long really anytime you want, just as long as you're not going long the day before the uptrend ends. The safe time to go long is during times of pullbacks where you can set a stop just below the reversal area. In a strong downtrend or bear market, there is no place to go long. There's nowhere for the perma bulls to hide because the only part that you made money going long are these small retracements. I use retracements to set up shorts, puts, contras, etc. in a bear market, and we have to wonder, are we switching from the left to the right, and that will need to affect how I address the market on a regular basis. This is the proverbial Darvis box. You sell at resistance, you buy at support, and then you look to buy breakouts or to buy breakouts and short breakdowns. we've been in mostly on the left. And then as soon as I think we're starting to go into the right, we break out and go to new highs. So it'd be interesting to see again, it might be different this time. This is an old slide that tells a story. The story is simple. The story is that over a 15-month period, many years ago, smart people sat in the library in Palos Verdes under the tutelage of Ian Woodward and chose stock picks. They were pretty good stock pickers, and in a strong market, after 20 days, their picks were up an average of 106% in a strong market. Now, a couple of things are pretty evident from the slide. The first thing is good stock pickers are not very good in a bad market. You can see the same people using the same criteria have major losses in a weak market. The second thing is most of the gains come early on some of these growth stocks, and by holding longer, all they did was saw moderation in their returns, and that's something that I think I should be considering how I trade and wondering about whether or not my holding period is too long, most of the gain being early on when they chose their picks. So bad markets, tough to pick winning stocks, and most of the gains occur relatively quickly. Just got back from a great trip to Palos Verdes the week before in Orange County, 2 excellent meetings. Unfortunately, in October, I'll be out of the country, so I won't be at either of them. But what you have is an ebb and flow of the market defined by the HGSI indicators. And you need to know where you are because it's very hard to make money on the way down. And we'll be looking for phoenixes and bingos and others to give us an idea of are we up here still moving up, or have we now moved into anxiety and denial, which I think you're going to see that on the charts. So a couple of comments. We've used the canaries as defined by Ian over a year ago to demonstrate where the strength was in this market on the way up, and what you can see the canaries have died. I did put on the last gasp, but on further review, that canary is dead. As you can see, we had a big red bar down on Friday, so we had a little bit of a rally Monday, Tuesday, and Wednesday. Sucked those bulls right back in. Did not close above the 8-day exponential moving average. Came down hard on Thursday and Friday. Weekly bond goes red, as is everything else on above. No go breakdown to the bottom. We'll probably stop watching the canaries unless something happens this week because they no longer are useful. In October, we put together a list of leaders, a little bit more broad-based. The canaries are 8 leaders, most of which are broken hard. The LLURs are 27 or 28 stocks that at the time of the October PD meeting represented the leaders, and you could see that it had pretty much respected the 50-day moving average since that time, continued up nicely since the October meeting. And on Friday, we broke down mobile breakdown with the squeeze. Bongo weekly is red. Kahuna to the downside, which is red. This is a phoenix, which tells you weakness in the market. And I think we have more evidence of this market has changed with the October LLURs. Somewhat disappointing is we picked a list on on Sunday, a week ago at the PD meeting of the new leaders. Here they are listed here. This is not designed to be a buy list, but rather to be a list of leadership to show us when the market turns. And one can see Thursday and Friday were quite weak at PSAR reversal and a pullback to just above, stopped at the 17-day and pulled back some below the 8-day exponential. So much better shape than the other 2 lists, but showing evidence of deterioration right off the bat. Market themes this week: momentum stocks were pounded for another week. A classic bull trap occurred Tuesday and Wednesday as the market ran up, sucking us back in, and then sold off hard on Wednesday and Thursday. High beta stocks are falling like rocks. As I did my review of leading stocks, there's clearly a shift to defensive stocks, food, energy, yield. On the yield side, REITs, MLPs, utilities, and bond funds all looked attractive. Big caps are starting to join the party. By that I mean over the last several weeks, we've seen stocks like Microsoft and Intel hit multi-year highs as money was coming out of the cha-cha-cha growth stocks and going into the more sedate or boring of the old caps, and I think that started to reverse. And the market's clearly high risk here, maybe in the process of rolling over into the land of the bear. Steps I took: continue to raise cash by selling stocks. Someone asked me at the PB meeting how many positions I own. Well, I was still kind of hoping to be really bullish, and during bullish periods I own a lot of stocks. I own very few stocks that are not protected right now. I'm fully out of margin. I've added to my contras. Those are the 4 that I'm holding right now. And on some of my long-term positions, stocks that I have reasons to not want to sell yet for tax purposes or others, I have put married puts on. Actually, I did them on Wednesday when premium was almost free. And the married puts are interesting. It's something I've recently been studying, and it's a way of limiting your losses. It's like any other insurance. You pay a premium for that. The premium that is a combination of the intrinsic value of how much in the money the option is, and these are deep in the money, plus how much the time value you're paying for. And by buying relatively deep in the money married puts, there's really no time value. And then what I do once the market settles down, I'm going to write calls against the stock and puts against the put I have at different price points, and collect premium, and I'll actually make money most likely on these trades, while at the same time I'm limiting my risk to the downside. I want to put this out here now. I appreciate everybody's comments. Unfortunately, I had 2 dates to work from, and one's getting close, so I chose June 21st to June 23rd. This is the weekend after Father's Day. There'll be other meetings if you're unable to make this. It'll be in West Palm Beach. I'm currently negotiating with 3 hotels. And once I understand how much the hotel's going to cost me, I'll have an idea of how many people and how much. My goal is to downsize what I do, i.e. I'm not going to supply all the meals. If I can have it in a place where you can get meals, I'm going to try and make it so it's close to the airport and affordable. The level, this would be, you need to know something about investing. You need to know what an option is and what a stock is. But you want to become an HGSI power user. The content will be at the advanced newbie range. There will be 2 webinars for those that attend before we get there, so I can go over basic, so everybody comes in with the vocabulary intact, and then we'll hit the ball running. A tentative agenda will be HGSI Unleashed, maximizing the software and the principles. This will be the major focus of the meeting, using EdgeRater, Magenta, and others as adjuncts to help make market calls and beyond. Going through my usual top-down reports slowly so you can understand how I look at the market, using the tools at market, sector, industry, and stocks. Going over a number of the critical bottoms-up tools that we have in HGSI. Once a trade is made, things about stocks versus options, high delta versus low delta, when to do money management, position sizing, etc. And we will look at other programs such as TradeStation and Thinkorswim. My target cost will be in the $600 range for the base attendee. As always, I'll make my TradeStation indicators available at half price for $250 for anybody that attends. And then if you want to purchase my TradeStation indicators alone, there's 2 price points. There's $500 or $600 depending on whether or not you buy the dots. So you almost get the indicators for free if you come to the live meeting because of the discount. And now on to the charts. As always, I'd like to start by reviewing the week that we had. This is using data that was taken a week ago Friday, so you can see March 28th. That earlier run, I used the wrong data file, and I looked at what happened if I went wrong at the close on Friday the 28th and sold my positions on the close on Friday the 4th. So as we go through, we see that there's some black and there's a lot of red. There's probably more red than black, but for as bad as it felt, there's still quite a bit of positive groups. The first couple of groups really don't have enough stocks for me to make a lot of comments on. But I can see some things here that are kind of interesting. If I look at the S&P 500, it was up 0.4%, so it's up nominal for the week. The HGS 100, it's kill one of the versions, was up a little bit more, 0.58, so that was an outperformer for the week. Stocks and groups to the upside, one of the pre-planned smart groups, so even in a bad tape, if you just bought the stocks that came up in this search, was up 0.76% for the week on the small guys. And the big guys right here were up 1.03%. So just using the smart group would have been a good way to make money. Some of the biggest winners, where there was more than just one or two stocks, had to be my mobile breakouts from TradeStation, whether there was a squeeze or Kahuna Force or not. These stocks seem to have done very well for the week. What didn't work? Most things. My all-star GIFs, you can tell, were down 0.59. IBD 50 was down 1.24. The best of Woodward and Brown, which represent the best criteria for the week before, were split 50-50. We're down 2%. Bible Gap Ups, breakout EPS All-Stars were down hard, over 3%. Breakouts within all varieties failed this week, down 8% from our routine breakout scan. Stocks and groups moving to the downside. All you need to do to find your short candidates perhaps is to focus on this list, which is what Phil Morales does. We're down 3.68%. The little guys were down less, down 1.1%. And the Canaries were down nearly 3% on the week. The October LLURs, I think, are up here somewhere. No. They're in here somewhere, probably highlighted, and I'm probably missing them. The October LLURs were not nearly as hurt. You can see the LLURs from this meeting were down only 0.18%, but Thursday and Friday were obviously really tough days for leading stocks. Here's the October LLURs. They were down 0.84%. Message here is market rolled over at the end of the week. Breakouts not working, our type of stocks lagging, and that the smart groups for stocks and groups to the downside is a great place to fish for shorts, and stocks and groups to the upside is a good place to fish for longs. Two other things that we typically look at. There was no new Hindenburg signals. You see the last signals here were back in December. This is a sign of imminent or potential imminent market significant correction. All significant corrections over the past 30, 40 years have occurred following a Hindenburg homing signal. Over only 25% of these signals are actually real or actually have an outcome. They require several characteristics. They require new highs and new lows below 2.2, a rising moving average of the index, McClellan less than 0, and the new highs cannot be more than 2 times the new lows. Essentially, think of high volume occurring and lots of turnover of the professionals wanting to get out of the market and us amateurs wanting to get into the market. You can see we have less than almost no new lows, and we're not going to get a Hindenburg omen until these are both above 2.2%, and we're nowhere close. So that can change quickly. From a bucket perspective, what are the percentage of stocks in the S&P 1500 that are above and below the midline of the Bollinger Bands? We're sort of at a shootout at the OK Corral. We're in the middle with no obvious trend here. You go back 2 days, you can see that we were in a lot richer position, so our portfolios probably. But as you can see here, started to get a lot of stocks above the upper band, although clearly not the highest we've seen. And then if you go back a week or so, you can see the opposite, where we were starting to get a lot of stocks below the Bollinger Band. So we've had some quick whipsawing here to a place almost of neutrality. If we look at the market picture that we get out of EdgeRater, we can see another shot across the bar of the bulls, where the last time we had kahunas to the red side across the boat, we went from a green or buying market to more of an indecision market with mostly yellow with some reds and some greens on the percent B. But if you look at the bandwidth times the percent B, the Woody indicator, all reds and yellows, having another shot across the bow of the bulls, and almost all indexes, this one missed by just 0.02, suggests to me that we've got a leg down coming. A lot of great things in EdgeRater. George Lee and I use things with the squeeze, mobile breakouts, PSAR reversals, etc. And George Lee signals are actually built into EdgeRater so you can run the market. There were many less buy signals than we normally see. From Gil Morales and Chris Catcher perspective, HGSI has built things called Code Red and Code Blue, where you can look at blue signals on force and bongos, presence of kahunas and pocket pivots, and you could see that you had only about 21 or so kahunas and Code Blue signals for long, and a lot more to the short side. So just the market setting up with deterioration. These are often good signals and worth considering for long and short positions. Enough of that. I like to go into TradeStation just to take a look at my elder signals. Bring that over. Apologize for anybody that's watching this a second time. The resolution, I made the mistake of changing my screen resolution after I signed into GoToMeeting, the result being that I recorded it in HD, Super HD, but my picture was only used up a quarter of the screen because I had already changed to 1080. But I got that figured out now, and we should be okay. Let me see my finances here. So elder signals, I look here at several things. I look at histograms, I look at multiple time frames, I look at the color of the price bar and the relationship to the auto envelope. So let's start with, let's go to strength. Let's start with the Dow Industrials. Blue, so that's sort of a neutral price bar, green on the weekly, blue on the monthly, so I have the ability to go long or short on the big stocks or hold based upon these rules. I am seeing that we're in price near value, which would be in between these yellow and red lines. The auto envelope, we're right in the middle, plenty of room to move here. What's disturbing is we had a nominal new high, and we have clear bearish divergence in the MACD line and the MACD histogram. That's a sign of weakness and a sign of concern. These are in the leading index. Brought it out a little bit. Take a look at the S&P 500. Let's look at the ES. And we see we've gone to red here, still in the middle of the auto envelope. Again, new highs and not new highs on the MACD histogram line, so bearish divergences, concerning. Blue on the weekly and the monthly, so deterioration in the big stocks here. We can look at the NASDAQ, and we see big red bar through the bottom of the envelope, so clearly the weakest thus far. It'll be interesting to see if we get a deeper histogram and MACD line before this is over. One could feel positive that once you knife through, this market's had a tendency to rapidly recover. But if you look to the upside, you can see that the market has a tendency of running up the band. So you could see this continue to run down, even though it's broken through the envelope. And then lastly, with the Russell here anymore, for that. But in the futures of the Russell, which I do get, You can see not quite as bad as the NASDAQ, but pretty darn close with the red signal there. So if you feel bullish about this market, God bless you. I don't. But that could change in a day. I think we've got high risk, which we've been talking about for the last 15 or 20 minutes. What I do as the market opens is I go into my radar screen here, and I put together multiple lists. I've got indexes, futures, 3x bulls and bears, sectors. The market, you can see, is not yet open yet. It's 6:35 Eastern time. Got stocks that I've been following. I've got a big list. And the advantage of TradeStation over Thinkorswim is that these are running all the time, and then I've got nearly 1,000 instruments in this list. And I'm able to run 30 different indicators against them all day long. So I'm looking for things like pocket pivots up and down. I'm looking at volume compared to normal. I'm looking at green candle lows and red candle highs. I'm looking at ISO failures. I'm looking at squeezes, mobile breakouts and breakdowns from squeezes. I'm looking at Bible gap ups, candlesticks, some MACD divergence. I'm going to show you how I use this triple trender from ARPS on each signal in a second. I've combined PSI reversals and mobile breakouts and squeezes into what I call the George Lee trigger breakout. And then I'm looking at some new indicators I have from Hawkeye, trying to see if they add to my analysis. All day long, I can be clicking on a column. So, for example, I see how many stocks had Bible gap ups on Friday. This morning, when the market opens, we'll see the gaps immediately and then the volume, and I'll know very early on who's likely to be a Bible gap up. That might affect some of my trading. You can see on Friday, though you can't see here because of changes, but there were some big reversals, specifically in Micron was one that had a reversal, had a Bible gap up, and actually ended up with a pocket pivot down. Very ugly day, despite not bad earnings. Now, by clicking on a column, I can see how many of the stocks had or having a Bible. This is a had Bible, a pocket pivot up. And do the same for pocket pivot down. And you notice that there were a lot more pocket pivot downs, which is potentially a bearish signal. I might look in my big list. I call them tigers for an old program I used to have. Green candle lows. You can see just a few. And these can be a reversal by their own. Yet red candle highs, considerably more, perhaps a sign of a market top. I can look and see how many are giving me a breakdown from the squeeze. Not all squeezes are having a move. How many are giving me a breakout from the squeeze? And then again, my Bible gap up. So I'm scanning real time during the day, looking for these signals. And that's why I like my TradeStation indicators so much. And I could also plot them on charts. And I'm not going to go over them today, but one of the reasons why there's a difference in the price points is that I basically, just like an HGSI, where I like to have my indicators all in front of me, I have what I call the JS dots, which have things such as, this is PSAR, here it's from the PSAR reversal. This is a squeeze. Then I have mobile breakouts, pocket pivots, and Bible gap ups. I've got forced kahunas, and I've got red candle lows and green candle highs. Actually, red candle highs and green candle lows, all in dots, so I can get a picture of what's going on just by looking at the color of those dots. So enough of that. Now, one of the things that I've got very interested in of late has been intermarket analysis. So I've been able to get some indicators programmed into each signal, which are pretty cool. And okay. So what I'm able to do is compare the relative strength of the first symbol versus the second symbol. And the first thing that I notice is that the diamonds, so the Dow and the spiders, are behaving the same. No surprise, they look similar on the elder signals. The 6 tells me outperformance, and that DIG, so oil explorers, are outperforming the big market. EEM, which is emerging markets, is outperforming. Come down here, and I see that, let's see which ones of these are. We have outperformance in the EWH. I can't remember what all these are, so I just click down here. It tells me that Hong Kong is outperforming our market. Now, the interesting thing is our market's selling off, and there's a lot of outperformance in this market compared to the U.S. stocks. Now, why is that? Hold on 1 second. There we go. So we have a lot of markets that are actually, hold on a second. Oh, my bad. So we have a number of markets outperforming the U.S. where, one of the things that I felt this weekend was the rest of the world is doing better than us. Gold miners versus gold equal, and gold starting to underperform the spiders. Small stocks, at least on the last couple of days, performing similar to the spiders. The Qs, no surprise, underperforming the spiders as is technology. Oil, underperforming producers. You can see a -6, so that tells me that oil exploration stocks are doing better than the price of oil is doing. The dollar, I don't know why they're twice, but underperforming the spiders. You see the VXX way underperforming the spiders, so even though the market is ugly, you're seeing a lack of volatility. You can see finances are neutral, financials, yet utilities have gone positive a little bit, and XLB, which is healthcare, has gone extremely negative versus the spiders. So I use this as another tool during the day to understand what's going on from a perspective of relative performance. I'll show you how you can set that up in TradeStation and other platforms during the meeting that I do in Florida. So now let's jump into HGSI and get a sense of what's going on in the market. Since it is 6:45 in the morning, it's hard to not take a look. So we can see the futures are already selling off, not a big surprise. And since I've gone to the short side in the neck perspective, I'm glad we'll see where we end up. So I like to start a warehouse view. I like to go down to ground groups. I got to clean this up. Major markets plus, put the T, so I'm looking at all price and volume looking over the last couple of weeks. And first thing is when you see the strength in the markets and treasury bonds, that's not good for stocks, gold, utilities, so defensive up at the top, followed by big stocks, and the small stocks and technology-laden NASDAQ are down here on the bottom. For the 5-day performance, the only thing that was up for 5 days was transports, utilities, gold. The major indices down, as was volatility. Now, 5 days is not really a good review because most of the damage was done on the last day, and you can see over 2% down on the small stocks in the NASDAQ and technology. So clear weakness has come into this market. Very quickly, let's look at some of these charts. S&P 500, we'll start with. Now, I'm not going to assume that you know what I'm looking at here, so very quickly. These are weekly bondos and daily bondos. They're still green on the S&P 500. This is percent accumulation distribution. It's neutral. Here's force indicators. Since you don't have volume, they don't show up. This is the high jump, so we've come off the highest high, but we did have a red candle high on Thursday. This is DI crossovers. This is Bible gap ups. This is squeeze and no-goes. On my price, obviously I use candlesticks. These are PSAR dots. These are sells. Greens are buys. This is Bollinger Bands. Here you can see the impact of the squeeze. Paints it yellow. This is an 8-day exponential moving average. The rest are simple 17, 50, and 200. The top volume bar is looking at, again, there's no volume here, looking at signals on the NYSE or NASDAQ. These are looking for eurekas and phoenixes, which when we get to where we are, because there should be one, there it is. And these are kahunas, which would be on whatever's in the window. So a couple of things that you should notice, and you're already well aware of, is we've gone almost straight up since a low in late November. So even though you probably gave up some money, if you were long this week, just roughly, wrong tool, Jeffrey, let me kill that. We are up in 346 trading days, so a year and a half. We're up 40% still. Now, what's kind of interesting is if I do put fibs on here, from the low to the high, and I look at where a 38% retracement is, gets me down to about 1,700. That would be deadly. But a 23% retracement would get you down to the 200-day moving average. So I think that's a possibility of where we may end up. And it will be interesting to see if we get to that point. Now I could make this bigger and then run another from this low up to the high. And we have almost retraced to the 23.6% here. 38% here is 1837. You see a couple of these lines coming together. So perhaps my target is going to be that 50-day moving average, which is still down another 30 or so points on the S&P 500. You could see why I call this a bull trap. As we hit an all-time high on the S&P on Wednesday, we actually opened up and traded above it on Thursday and came down with a sort of a spinning top, but that qualified as a red candle high. And then on Friday, we actually opened up, traded above to a new high, and came down hard. So there's probably bulls that came in at the last minute and are now trapped, stopping at the 17-day, Phoenix on the markets in general, and a big kahuna to the downside. So clearly weakness in the S&P 500. Very quickly, because I don't think it's going to change much on what we've already talked about, we'll take a look at the Dow. Below the 8-day exponential, the two had a kahuna to the downside. Notice the bongo weekly is red on the Dow, so the uptrend has been gone for some time. It's sort of been in here and chopped. Is it rolling over? Perhaps. We look at the NASDAQ, you'll see much more weakness, wiping through the 50 on the way down to its 200-day moving average of about 4,000, which will be rising. So you could have another 150 points down, perhaps in the NASDAQ before this carnage is over. And then on the Russell 2000, the small caps, not quite as bad as the NASDAQ, but also breaking through its 50-day moving average. Bongo, weekly red, kahuna to the downside, Noble break down from the squeeze. And I believe the NASDAQ also has the weekly bongo to the red. So we've got weakness throughout on the big boys and the little boys. If we look at Treasury bonds, pull back to the 50 and moved up this week. Some strength here, which, as I noted before, not good for the market. Volatility, interestingly, remains relatively low. I think it's a spring that's coiling, and it would not totally surprise me if we see a move upwards in the volatility this week. Now, the reason why my Mary puts were so cheap was I was able to buy them when volatility was as low as it's been. they'll get more valuable as volatility increases, as that time period is going to increase as well. Every time we popped up on volatility, it's got whacked down, but we're down, and we know from George Lee's comments that as volatility rises, it's when the market falls. For the gold bugs out there, a little bit better week, and you can see gold has gotten back above the 200 and may be setting up to go challenge its most recent highs. It's got to get above the 50 and the 17, and then it's got some blue sky above it and might make a run. Utilities are strong, which is not a sign of strength of the market, but rather a sign perhaps of a move to defensive stocks. And lastly, silver, which has industrial uses in addition to the shiny aspect, weaker than gold and well below the 50 to 200. But there'll be a disparity between silver stocks and the gold itself. In the metal itself. We look at industries, talk about getting kind of ugly. You can see we start with 149 industry groups here. And as soon as I flip to force down up, you see that we're down to 9. So only 9 groups, this is the lowest number in a long time, are showing positive, versus to the downside on the force, we have 38 groups. Now, the force being price change today minus yesterday times today's volume plotted, and then you look at a 2-day and a 13-day exponential moving average, is a very short acting, heavily influenced by volume indicator, and so it probably skews a little bit of what ends up in here as being higher volume, although certainly electrical components are not high volume. Pharma and biotech, interestingly, do not make either list. And perhaps it's because, there's carnage, they're big groups, and we'll take a look at those specifically. However, if you look at to the long side, you can see defensive REITs, funds, utilities, gold, and metals. So it's pretty clear here that growth is not in style. If we look quickly at some of these, at the gold index, we already looked at gold getting above the 200, and what you'll see here in the charts is this looks just like gold struggling to get above the 200 on Gold Core. American Barracks, it's above the 200, trying to get above its PSAR dot and above the 50 and to move up. El Dorado gold looks even better, if I remember correctly. No, it doesn't. Actually, this one looks worse. It's deep behind the 200, so it shows that these are coming off the bottom again. Here's Royal Gold. This is the better one. It's above the 200, pull back to the 50. Had a breakout, global breakout on Friday, and this might be a leading gold stock, continuing if gold makes a stand here. AEM, that's also got nickel and others, is also in an uptrend, pull back, and looks like it wants to run again. If gold goes up, all these stocks will move to the same direction. Utilities, I think the word here is yield. I'm not talking about energy yield. I could look at all of them. I'm not in the essence of time, especially since it's a redo. They make money, but no earnings per share growth. Huge uptrend off the bottom in mid-January, perhaps as the volatility in our portfolios, although not in the market, started to move up. Pocket pivots on Friday. Everything is green. I won't show you any growth stocks that look like that, most likely. And why are these doing well? 3.6% yield. Entergy, electrical utility, similar pattern, 4.8% yield. Southern Company, not quite as good of a pattern. A little bit closer to its 250 and 17-day, but you see the cross, the 50 over 200, a pocket pivot, a mobile breakout from the squeeze. Bongo weekly is green. You see a yield of 4.6%. I think the story is clear. People are getting defensive, and they're buying yield. Independent power producers, when do we ever look at stocks like this on these calls? This is rotation into defensive plays, and I'm not going to spend a whole lot of time looking at these because they're not what I like to buy, but it's evidence of the weakness of the market. Big run up, everything is green, 1.5% in NRG. Dynegy doesn't have a yield, but a similar chart. AES has a 1.4% yield. Back here, precious metals, some of the silver stocks are in here, and you can see that these look a lot better than the silver metal itself looks like. So this is not just gold miners perhaps that are outperforming their metal, but you can see already an uptrend, a pullback to the 8-day and 17-day, and a gap up on Friday after a mobile breakout of the squeeze on Thursday. In Stillwater, this looks quite strong, much stronger than the metal. SSRI pulled back to the 50, also had a move up on Friday, mobile breakout without a squeeze. Weekly bongos are green, although the short-term ones are red. So you could see that these are clearly stronger than the metal itself. There might be a place to hide as well. I'm not going to go through all the utility stocks. Construction materials, there's a lot of talk about these guys being in a bubble. I think they're up here because 14 million shares traded in CEMEX, which I believe had a settlement with the government that was more favorable than expected, and that might be why that stock topped. I unfortunately think it's a story here as much as it is anything else, but you can see what a pop looks like. Stock that's been in an uptrend, pulled back through the 50, and now you've had sort of a cup and a handle. I know I'm seeing things there, so don't really pay that much attention. Maybe it's been in a bigger cup, but whatever. You've had two kahunas in the last 3 days, and a weak tape, a pocket pivot, a gap up on Friday from a squeeze. Everything is green here. This is one of the better looking, believe it or not, charts you're going to see today on stocks. Martin Marietta, nice run up, pull back to the 17, positive day on Friday, probably in sympathy to CEMEX. Eagle Materials, don't like the shooting star here. It'll be interesting to see if it gaps down in the morning and gives us an evening star. So a little bit of interest in that group. And then the REITs, another place where you might find some interest, some dividend yield. The residential REITs here, you can see accumulation distribution is strong. And up here, pullback, not that exciting, nice growth rate, but you look at these different than you would a growth stock. 2.8% on Essex property, 3.5 on Avalon, 3.8 yield on American Campus, 3.4 in equity residential. I think the story here, like in utilities, is yield. I can't believe we're talking about REITs and utilities. This is why I think it's different this time. And then a lot of the closed-end, mostly bond funds, also made it to the list. Not all these have a dividend, which I thought was strange because why would I put my money in these, although I guess they could have some growth stories. But you can see here the group strength on this is very high. This is BlackRock Municipal Term. Mobile breakup from the squeeze, everything is green in a kahuna. So this might be setting up. I wonder if they're just not capturing this. So you might want to look at other sources for the yields on these. Here's Nuveen, intermediate duration, pull back to the 50. If this was a stock, growth stock, I'd be all over it. Everything is green. Hit a mobile breakup from the squeeze on Thursday, 2 kahunas in a row. So I guess the message here is pretty clear. What's working are places that we don't normally play, and I think gives you an idea of how soft this market is, or at least the concerns about the market. To the downside, don't really have enough time to look at it, but I think there's a lot of things to be aware of. Tesla, the other manufacturers, the airlines, oil, gas exploration and production index, apparel and retail, hotels and resorts, computers and electronics, insurance, managed care, diversified chemicals, paper and steel, consumer finance, aluminum, gas and storage, metals and mining, air freight and logistics, home builders, coal, a lot of places that have had recent strength. You can see green 13 days. These are things that have been in uptrends, might be getting ready to roll over as this market goes the wrong way. So we've now gone through the market, the industry and some of the leading stocks in the top industries, what else would I do? I would start to look at some bottoms-up routines. So I go up to all securities. But actually, before I get there, let's look at biotech. And let's look at pharma. So let me just put it into more balance. Let's look at over the last couple of weeks. So if you look at biotech and you look at one-day performance, there are 105 stocks here, and we have 14 of them that were positive. Of these, this was on Friday, Myriad was a story stock, as with increased reimbursement. That means over 100 to the downside. Look over the last 5 days, a little bit better. We got 29 to the upside, and again, about 80 to the downside. Mankind had its approval. We talked about the last HGSI meeting. Both Lardy and I are concerned that it's going to have challenges getting this product to market still. They didn't get an approval. They passed an FDA committee. A big move up. Myriad had some reimbursement news. But let's just take a look at some of these big cap guys. So let me take a look at some of our favorite players. Biogen IDEC, clearly one of the big leaders in biotech. Broken stock, you can see it went red weekly, 2 weeks ago. Big down day through the 50, did not bounce, continued to fall. My guess is it goes and tests its 200-day moving average. Intercept. Remember in January it had the one-day pop, and I said to stay away and be careful. It's never made its way back to the closing day, close of day number 2. Actually, it made it there once above where it closed on that big gap day. And it's pulling back, and I think its 200-day, which is a 50% hit from here, is not out of the question. They did what they needed to do, which was they did a secondary at over $300 a share. They raised money to get the drug to development, but it's still an early phase drug that's already got some competition. Celgene was a leader. It's now a big laggard, leading the Dows. Now, where is this target? I have no idea. I am no longer long in Celgene. I've been not long for a little bit of time. Gilead bounced off the 200 and was struggling to get back and stay above the 17. Alexion, like Biogen, perhaps heading towards its 200-day moving average. Amgen had held up until Friday, sold off hard. Went to the downside, everything was red. Not a lot to like here in biotech. Now, one thing that I like is BIS. BIS is a ultra short of biotech, and my target here is the 200 or about $24. You can see this retested on the 50 and is moving up on volume. In fact, if you look at the volume over the last 10 days, biggest volume that this has ever seen, you can contrast this with perhaps shorting the IBD and seeing it's just like Celgene and Biogen IDEC heading back towards its 200-day moving average. So a lot of weakness in biotech persists. I go up to all securities. There are a number of things that I typically do. I can go into my favorite warehouse views, of which you know one of them is Sprinters. I got to pull this up because there's no way you're going to find what I'm looking at. Sprinters one step with Bongo. This is usually a big list for me, and you can see there's only 26 stocks here. A couple of them I think have a nice story. If I look at industries, you'll see a lot of auto parts and equipment. They look like they're rolling over, as do trucks. Holy cow, Questcor just got bought by Mallinckrodt for $5.6 billion. Wow. At least we don't have Questcor to kick around anymore. Well, that'll be interesting. That might drive some life into biotech today. Questcor has been one I've talked about, been in and out of over the years. Hopefully Bruce Berthoff, who's got a lot of biotech, still is holding Questcor. Just to look at some of these to give you an idea on the auto parts when I say rolling over. You see stocks that have been in uptrends that on Thursday and Friday have pullbacks. This is Gentherm, one of our LEURs. Here's Magna. Here's Shiloh. Here's Tower. All of them, might be places to play if this market resumes. They've certainly been leaders to the upside. They all showed some weakness on Thursday and Friday. On the trucking, similar things, uptrends, but looks like they're slowing down here. Again, we could come out of this relatively quickly. So that's some of my Sprinter bongos, and that's kind of what you're seeing in this market. Of these, some that I really like are leaders. Gas log has been one that I've been in and out of. One that will look like the last set, which is a tough day on Thursday and Friday, but one that's been a really nice uptrend, and perhaps we're going to set up a little bit of a bull flag and run again. You can see everything is green here, but it too had a kahuna to the downside, great earnings per share growth. So I like to look at various warehouse views, and I also like to look at my group inclusion filters. Since I'm not going to run it now, so I've already run it, let me just get the scorecard view here. And go down here to the one I already ran. And very quickly see if there's anything in here that might be worth pointing out. See, a lot of them are in squeezes. Don't know what this stock does. EMES, it's an energy, oil, and gas field services. It's a limited partnership, which means it's probably got yield, 5.5% return. High ROE. This was one of my favorite looking charts of the weekend. Getting extended. It's at its high jump bar with a red candle high. Everything is green. Expensive. Volume coming in. Doesn't trade enough, perhaps. 172,000 shares, but a strong looking chart. Spirit Airlines has had a huge run. Looks to me like it wants to roll over and test its 50. The airlines were weak. Michael Kors was a leader, and it's breaking down below the 50, perhaps heading towards that 200. Gentherm, we already looked at the automotive getting tired. Magna, automotive getting tired. These are the best of the best from the group inclusion filter, and they all are looking tired. Here's Tower. Myriad Genetics, I said they had great news. Gapped up, probably gapped up on Thursday, gapped up again on Friday. It's a red candle because it closed below the open, but it still closed up a lot for the day. On less volume, everything is green. This was based upon news on reimbursement. Methanex sold off to the 50, doesn't want to run again. It's still got a weekly bongo that's red. It's got some earnings coming in. Alliance Fiber had some good news because the gap up on Wednesday went sideways the rest of the week. Really didn't give up the farm, and this might be one to look at if there's strength of the market later in the day on Monday. Federal Signals and construction machinery, farm trucks. Like the auto parts, the automobile manufacturers seem to be rolling over on Friday with a bearish engulfing pattern and a kahuna to the downside, but still early. Eagle Materials is that construction stock we already looked at. Cement, Samuel Martin Marietta, I think, unless this is the construction materials. Pull back to 50, we already looked at this one today. Holysys Automation is a electronic equipment and instruments. New high territory pulled back on Thursday and Friday. Long-legged doji that opens up on Friday after this pocket pivot in green might be something to look at. Wine Technology is a healthcare services company or technology company, tech company, pulled back, broke above the 50 with a Bible gap up on Friday with the kahuna, still weekly red on the bongo, which is bothersome, but it makes money. That might be a place of strength. Here's one of our utilities. Here's that gas log. Continental EOG with a couple of the oil exploration stocks that we liked last week. They had a rough day on Friday, but still in an uptrend. Still strength there, I think, overall in the market. Here's EOG. Here's Matador. Here's Sanchez. So you can see this stock. This one is broken down a little bit more than the others. Southwestern Energy. And then Packaging Corp of America, which doesn't look like much on the daily, but if you look at the weekly, you can see how there's been a really awesome move up from June of 2012. Still in an uptrend. So this might be a short-term correction, and it might be a place to jump back on board. You can see their awesome earnings per share growth, and they pay a 2.2% dividend yield. Pulling back, perhaps going to be a good buying opportunity off the 50 coming soon. Questcore, now does this look like it was going to be bought out today? Doesn't look like it to me, as it had a bearish engulfing pattern on Friday. I wonder what the per share amount on this acquisition is. Let's see if we got news on that. $86.10. Wow, for a $20 premium. $3 in cash and then some shares. Wow. Immediately accretive, so both of them will probably trade up today. Wow. $20. No one saw this. Interestingly, they bought it at a 5% premium to the most recent high in February. So congrats to the people holding Questcore. Why it kept holding it after Friday, no one knows. It's been Bongo Weekly Red, but this is what you hope for. You got your lottery ticket. Hilltop Holdings is a bank holding company in a sideways consolidation, a bunch of pocket pivots and kahunas, something like the happening there. United Insurance, don't know much about that stock. Airlease Corporation, basing up here. Interesting to see if it breaks out or breaks down. It had a pocket pivot down with bearish engulfing on Friday. And Qihu is broken down, heading down towards its 200. These are the GIF, the best of the best. Cynics, great earnings per share growth. Bible gap up on Friday. Multiple kahunas during the week. Everything is green here. Kind of extended. See, it's up to the top of its high jump bar. But there's a story to this stock, and I need to go figure out what that is. United Rentals, one of the stocks that I've been a long-term holder. Big move up. Knife through the 17. Still a very bullish pattern. Right now, just a short-term pullback, but the kahuna to the downside. And a mobile breakdown, I'm a little bit concerned about it, but this might be one to look as well. And that's it on the group inclusion filter, which are some of the leading stocks. If those are leading stocks, that tells you the state of the market. What about shorts? I'm running out of time. I want to get this up before 8 o'clock, and I still got to process it. I actually think I found more stocks to short than to buy this week. Here's my buy list to see if there's anything I want to point out. I'll point out a couple of things. Most of these are already looked at. These are stocks that I'm interested in. Nothing is a buy on the open. Here is coffee, which pulled back and broke above its 23.6% retracement on Friday, pulled down to the 38.2% fib retracement. So this is an ETF for coffee. Pull back to support kahuna, mostly green above. Looks to me like it wants to run. The green candle low, had a DI crossover and a mobile breakout, but not from the squeeze on Friday. Thought that looked interesting from the long perspective. Best Buy is a bit of a bottom fish here, but they had a pocket pivot and a kahuna. It might be a place to look at if you're into bottom fishing. Most of these we've looked at already. Seadrill, also the bottom fishing play. Why would I be looking at this? It's an ugly chart. Yeah, it is. But sometimes I'm a yield whore, and it pays 11.1%. It's a oil and gas driller. Don't know much about it. Blue Powers, if you're watching this, let me know if this is some place I might want to consider. I love the yield. On the short side, we always stop this if you actually want to look at those. They're not beautiful stocks. You'll see a lot more. See a couple of my favorites here. And this is a pattern that you'll see a lot of. This is Under Armour. It's too late already. The short was probably on Friday as it broke through the 50. Does it head down to the 200? We already looked at cores, a similar pattern. NetScout, perhaps a little bit earlier, an opportunity as it broke through the 50. This opens down today, new weekly Bongo sell. Workaday, I mean, how much is this done falling? I don't know. It doesn't make money. It was way overpriced. It's crazy. It's now making up for it. I'd rather see it bounce back up to the 50 to short again. Although if it fails at the 200, retests, fails, and continues down, it might give you a new opportunity for shorting. You've got Tesla. When's this going to stop? Is it going to bounce here? Maybe. Or is it pull back to the 50 or 200? I think the market's going to tell us. GameStop had a Bible gap up. No, not Bible, because it's going to we had a gap up on volume on the morning Friday and closed with a bearish engulfing pattern. It's failed at the 200-day. It should take out its prior low down here around 33. So you potentially got 8 to 10 points to the downside. Now it's got some fundamental strength, but a failure at the 200 on good news is not a happy signal. Are the railroads producers going to sell off? Well, this one already is selling off. Let's see the bounces at the 50. I'm keeping it on my potential shorts list. Zeltec, don't understand this company. They get rid of fat with cold. Failed at the 50. Not a big run down to the 200. It's been going sideways. If I flipped the stock and did a reverse, you'd think it was breaking out. I think this is breaking down. Potential short candidate. Probably a little late on LinkedIn. Let it come back up to the 200. This is one that Guild called appropriately. Amazon, when's it going to stop? I'd like to see a retest here and a failure and come right back down. So there's a lot of stocks that are good-looking shorts right now. W. Granger failed at the 200-day moving average. Does it come back down at 230-ish, which would be a $25 move? I think there's a lot of potential to the short side, and frankly, this is one of those rare weeks where the shorts look better to me than the longs. So we'll just go back here to finish and remind everybody that I announced that I am doing my meeting 21st to 23rd. There'll be more information coming out over the next couple of days, but it will be in West Palm. We will stop probably late on the 23rd, which might mean you spend the night Monday if you wanted. It'll be optional because we'll stop the meeting at 4 o'clock so people can get last flights out. And then I'll resume the meeting at 7 o'clock after the data is updated. We've had a 3-hour break, and we'll together do a top-down review of the market and try and find some things to buy and sell on the 24th. Monday will be live in the market, putting what we've learned on Saturday and Sunday to test. Everybody have a great night. Sorry for the bad recording. Hopefully this one came out better. Take care and good night.